Okay, let's talk about the advantages and disadvantages of a corporation. Some of the main advantages is limited liability. So this means that if you invest in the corporation and that you're a shareholder, that means you're not going to be liable for the things that a corporation does. All you can do is lose your initial investment. And if the corporation goes bankrupt, they can't come after the personal assets of the owners for those funds. So limited liability is a good thing. Another advantage is lack of mutual agency. This means the shareholders cannot bind the company by their actions. So the exact opposite of this would be a partnership where a partner can actually bind the other partners in the company. So a partner can bind the other partners in the company by anything that they do. However, in a corporation, shareholders are separate from the company, so they lack that mutual agency. The ability to raise capital, we can raise money by issuing stock. And then moving on to number 2, a disadvantage would be double taxation. And they're taxed at the corporate level, and they're also taxed at the distribution to the shareholders in the form of dividends. They also have more regulations, so they have more rules to comply with. And more rules mean more paperwork for the corporation. There's plenty of other advantages and disadvantages, but these are the main ones that we want to talk about. Okay, and then for number 3, shareholders elect the board of directors of a company. So that's what shareholders can do to exhibit their control, is to elect the board of directors. Wrong thing here. Okay. Gonna make that a little bit smaller. We're talking about par value on number 4 when we talk about common shares of stock and preferred shares of stock. Okay, so par value is that arbitrary value, that legal capital value assigned to a share of stock. We use it in accounting when we credit common stock or preferred stock, because we do the number of shares times the par value, because that's how we always list our. We also use par value when we want to calculate our preferred dividends. Remember, we say percent times par times number of shares. So those are the times we use it in this chapter. Okay, so deficit as it relates to retained earnings of a company. So retained earnings is a capital account, and a capital account has a normal credit balance. What if this capital account, this retained earnings account, has the debit balance? This means that it has negative earnings or negative accumulated earnings. This account should have a positive balance, but if it is a negative, that means it's a deficit, so it has a negative accumulated earnings. What roles do the board of directors play in a company's operations? Remember, the stockholders elect the board of directors, and then the board of directors decides on major business policies. They have specific duties like authorizing contracts, setting executive salaries, and arranging major loans with the bank. They're also in charge of declaring the dividends. So they're in charge of major decisions, declaring dividends, and setting the officers' salaries. How are preferred stock cash dividends calculated with giving a percent and a dollar amount? So we talked about how to do this when given a percent. If we want to know how much we should pay to preferred stockholders, then the formula is going to be percent times par times numbers of shares, and the order doesn't matter here, just multiply those 3 together. If you're already given a dollar amount, that dollar amount is already percent times par. So percent times par, that's your dollar amount you've already given, so you just take that and times it by the number of shares. So percent times par will give you the dollar amount. So if they give you the dollar amount, you're one step ahead. And this is how you calculate the number of preferred dividends that should be given out if the board of directors authorizes enough dividends to give out to your preferred stockholders. What does cumulative preferred stock mean? This just means if we don't pay it all in 1 year, we'll pay them when we do pay out dividends. So this is what gives us those dividends in arrears. So we accumulate the amount owed to preferred stockholders before paying common stockholders. Let me do that on the next line. Before we pay the common stockholders dividend. This is what we did when we practiced those cumulative preferred stock. We figured out how much preferred got, how much common got, and then figured the dividend per share, which is when we took the dividend and divided it by the number of shares. Okay, what is the journal entry for issuing stock at par? Well, we issue stock because we want money, so we're going to debit cash. And then we issue stock, so we would credit common stock. We would issue preferred stock the same way, but instead of crediting common stock, we would credit preferred stock. Okay, what is their journal entry for issuing stock above par? Still debit cash. Still credit common stock at par amount, and then the rest goes into additional paid in capital or paid in capital in excess of par, either one of those. Okay, what are the two sections of stockholders' equity? What is reported in each? Well, the first one is paid in capital. And this is everything to do with stock. Okay, and the second part is retained earnings. And this is all of our earnings, less our distribution from dividends. What is a stock dividend? This is where instead of giving out cash, we distribute stock. Okay, what is the journal entry for a stock dividend? So we're going to have dividends, and this is the number of shares were given out times the market price. Okay, and then we're going to credit common stock dividends distributable, and this is going to be the number we're giving out, the number of shares we're giving out, times par value. And then the remainder is going to go into additional paid in capital. So the excess market price over par. What three conditions must be met for a corporation to pay a cash dividend? First, the board of directors must declare it. Also, they must have sufficient cash and sufficient retained earnings. Okay, so what are the dates of the journal entries for cash dividends? First, we have the date of declaration, and this is where we set up the liability. So we set up the liability, we promise to pay on that date. Then we have the date of record, and this determines who gets the dividend. Okay, and there's no journal entry on that date. And then we have the date of payment. This is when we pay the cash. Okay, treasury stock. So treasury stock is when we buy back our own stock. Oops. Okay, and what are the journal entries for the Treasury stock? So we're going to debit Treasury stock and then credit cash because we're buying it back. Okay, and then when we turn around and sell it, we're going to debit cash and credit Treasury stock, but only for the amount that we bought it back for. And then anything over that amount will go into additional paid in capital Treasury stock. Okay, so for the cash amount here, you take the number of shares times the actual amount, the per share amount you got. Then for Treasury stock, you'll take the number of shares that you got times the original amount that we bought them back for. And then the rest will go into additional paid-in capital Treasury stock. If you need a credit to balance it, you credit it. If you need a debit to balance it, you will debit it. It will depend on if you bought it back for more or less than what you originally bought it for. You might want to make a note that you will not use par value at all when you're dealing with Treasury stock. Okay, let's look at a stock split and talk about the reason why we do a stock split. So if the price of the stock gets too high in the market and we want to get that price lower, then they can do what's called a stock split to get that price down. And in this question, we're going to do a 4-for-1 stock split. And then we're going to do a 2-for-1 stock split. So what you will do is you will divide the par and you will multiply the number of shares. And you won't need a journal entry for this. Okay, so for the 4-for-1, we're going to take the $20 par and you will always divide by the first number. So $20 divided by that 4. So 20 divided by 4 would be 5. So 5 is our new par value for a 4-for-1 stock split. Okay, and then for our shares, you always multiply. So we had 100,000 shares, so we're going to multiply that by 4. So now we have 400,000 shares of stock. So the total stock value did not change because 100,000 times 20 is 2 million and 400,000 times 5 is 2 million. So the stock split, the total amount does not change. We have just increased our number of shares and decreased our amount of par. Okay, let's do our 2-for-1 this time. So this time you're going to do 20 divided by 2, and that would give you 10 for your par value. And then you would do 100,000 and you would times that by 2. So you would get 200,000. And if we say the number of shares times par, we're still going to get 2 million. So it doesn't change the total value of our stock, but it does make our par value go down and the number of shares go up. And if you had a market value here, you would do the same thing, divide by 4, because in the market, if this happened, it would drive it down.